It's not very often that I'm in the Zoom with another Christine.
Right, that's good.
Welcome, everybody. Thanks for joining. We should start in a few minutes. Just let everybody trickling in. Register. Get your name down.
Yeah.
Big plan for the Halloween today?
Yeah.
Nothing? No. I need to get some candies before the trick-or-treaters showed up.
Kids are on the cusp of no longer wanting to hang out with me.
I know. I learned from last year, actually, if I buy on Halloween days, all the good candy is gone.
Oh.
So I did not learn my lesson, and I'm doing it again today.
Great, everybody, we know you're here. We're watching the numbers come in. So we're just going to give it another minute or two and then we'll get started.
Debbie? I think more people will join us later. Well, welcome everybody. Thanks for joining today. My name is Christine Minotto, and I'm the other Christine. I'm the executive director for UCSF Roseman Institute, and today we are so excited to have J.Thelander from J.Thelander Consulting Firms to join us to talk to you about everything about compensation. And this is such an important topic. It's always on founder CEO minds when it comes to bringing the team together, and especially at this time of the current market situation. It's always, you still need to get work done. You still want to make sure that people are rewarded for the hard work they do. And also with the challenging market, there's a lot of intricacy that you need to think about and learn from different options that you can do in order to keep the team going. So today, Jody's going to have a lot of insight on what has been done in the past, what currently the trend, like what are the things that companies are doing, and then answer any question you have. So with that, I'm going to introduce you a little bit about background on Jody. I think Jody's been in this field for decades, and so she has seen it all. She has seen the up market and the down market. So it's always good to have somebody who has seen not only the up market, the down market is always the hard part. So I think we can hear a lot of insight from her, and she has a lot of data to share with you. So it's not just a hand wavy, but something that's concrete as well. So with that, I'll turn over the microphone to Jody.
Great. Thank you so much. And thank you all for joining us. I will start out by saying we would like this to be as interactive as possible. We did get a list of questions ahead of time, so we have those to fall back on. But we also have Morgan on my team monitoring the chat as we're talking through different data and compensation information. So if there's any questions that you have and you want us to take a pause and go back and look at something, please feel free to put that in the chat, and Christine Leon Connors and I will address that. So I'm going to introduce Christine Leon Connors, who's been my partner in crime we're going into decades here now. And Christine was the former head of the private bank for JP Morgan in Northern California, and now is the president of Epic Capital. And Christine is her expertise. We've partnered with this on looking at compensation and the growth trajectory of companies starting from their earliest stage of financing through a liquidity. And really, Christine's strength and expertise is in looking at ways to maximize the wealth and minimize the taxes and do all the planning from the earliest stages on, because I think the planning is the most important aspect. While we have the great data and numbers, using it is also a whole other area, and the collaboration of both of us is extremely valuable. And I'm going to turn it over to Christine so you can share a little bit more. I will say Michelle Park from NEA was taken with a family emergency, and so she's hoping to come back on, but I apologize that she last minute had to drop off. So Christine, fill us in a little bit of what's going on at Epic Capital and your view on the market.
Thank you, Jody. And it's so great to see all of you and excited to do yet another one of these. We've been doing these for, sorry to say decades, but in my new role at Epic, we're seeing a lot of the same. And I just think the market, the way it is right now, the lack of kind of liquidity events, M&A transactions, more specifically IPO, is just carrying companies private for longer. Also, obviously, a reset around valuations. And so a lot of questions around just thinking about resetting of equity awards and equity grants. However, having said all that, I do think there's a really positive and in this whole scenario, which is the growth of new businesses, new companies, and all of these private companies that have been founded, over the last 5, 6, 7, 10 years that are now in really great growth positions. And you're seeing a lot of these new CEOs and or founder CEOs also looking and reevaluating their compensation as they're preparing for what would have been the right timing for them anyway in the next year or two of a liquidity event. And so really trying to get their ducks in a row for themselves and their team. So it's a little bit of the tale of two cities. Certainly some companies that have been at it for a lot longer and kind of seeing this drive to having a bit of reset around valuations and illiquidity. But then you're seeing the flip side, which is actually a really exciting time and a lot of talk around what do I own and how do I own it. And so as Jody mentioned, we're spending a lot of time just helping to advocate on behalf of our clients, usually the executive levels, but also giving some information and tidbits to the investors on the venture side too. And so we've got a great perspective, and we'll talk a lot more about just making sure at the individual level you really understand what you own, you're able to optimize around your ownership, and you're able to really, by understanding it, advocate and holistically really make the right decisions. And so, what I find, and I think I'm going to pass this back to you now, Jody, is just I think that it couldn't be more of an important time now just to really understand the mix of compensation and how companies are thinking about it and how executives should be thinking about it. It's also really hit home what we've said for over 2 decades, which is you really can't go by valuation. You really need to go by rounds of funding and how much you've actually fund over the total life of your firm as you're thinking about kind of equity pools and equity grants. So I think with that, I would love to turn it over back to you, Jody, to really run through some of the data, and then we can kind of dive into more of the information around the data.
Great, thank you. So the title of this event was Learn the Secrets of Compensation and Liquidity. So we're going to give you all the secrets. So by way of background, we here at J.Thelander have been surveying private companies for more than 25 years. And it's pretty crazy. We started only doing life sciences back in the day. And of course, now there's so much overlap and synergy between life science and tech, and certain jobs are just competitive. The exciting part about J.Thelander over the past few years is that our compensation surveys now are open year round, and the platform is updated daily with new information. So it's very real time. And I think that alleviates questions around, when was this data and what's happening in the marketplace. So our data has come from multiple of our surveys, private company compensation. We also run an annual survey on salary increases, bonuses, and option pools. And a lot of questions came in around what should, how does the option pool factor in, as well as merger and acquisition, which has, been a way of liquidity for private companies. What happens in those situations with change in control and severance? And also, how do you compensate your outside board members? meaning non-investor board members. The titles that we cover on our platform start from the CEO all the way through VPs, directors, clinical people, regulatory, engineers, designers, sales, marketing, business development, because we see with our clients in the consulting side that no two companies have the same key employees, right? You can have a very junior person who's also very valuable to the company. And we have started, also we included in the deck for today, which we have a lot of information, so we're not going to go through everything, but we're going to try and move this around so that we accommodate what you're looking for. There are premiums for certain jobs. While it's still a tight job market in some areas, other people, there is not quite as much competition for talent. So these are all the roles. We do publish, I think the data is great, but it also is helpful to put analysis. And we have now our private company digest, which we publish monthly. And here's a list of all the titles about gender, total financing, impacting severance, compensation for biotech companies, Europe versus USA. When Michelle was on from NEA before, she was saying they're doing quite a bit of investing in European companies, and there's a different, priority in terms of data premium. Life science males versus females. Anyways, a lot of good topics here, and we will send out a link to the survey at the end of this. Herminio is going to do that because you can participate for no charge and get a subset of the results and have access. So that's sort of your way to see what the content came from here from our webinar today. So let's dive right into the private company and executive compensation. So our data is divided between biotech, device tech, and a little bit of clean tech companies. The total financing raised today, Christine, you mentioned this. This is our recommended way to run custom reports and look at compensation is by total financing versus looking by valuation or series of financing, because somebody's Series A could be somebody's Series B. So the total financing amount is more exact. And as we spoke of here, right, you've got a lot of companies that have raised 200 million plus, 110 million plus. So there's more money going into the financing rounds and less of these companies going out to go public at a very small amount of financing, right? Things have stayed quieter longer. Primary location of companies, 90% give or take of our data is domestic. And then within the United States, we cover the country. And we also have some data we'll look at on how geography is impacting compensation. And then let's get in right away to the good stuff. And Christine, you and I are going to talk through this together. Sort of, let's go through compensation 101. What are the basic levers for compensation? Base salary, current bonus we survey, which means what's the bonus that was actually rewarded, target bonus, which is the bonus out on the horizon. And these are considered your sort of short-term incentives, right? Because they're within a year. And that gets you to total cash. And the total cash can be a combination of base and bonus, or it can just be base pay. I mean, a lot of early stage companies don't put in place bonus metrics because it's too confusing. And then the equity is the long-term incentive. And we'll get into the vesting schedules, typically 4-year vesting with a 1-year cliff. We have seen some movement to 5 years. And we also had quite a lot of questions on founder versus non-founder. So we look at founder shares for equity. So that's the percentage of fully diluted shares when you're a founder of a company, and there's no actually like one legal definition of what a founder is, but obviously someone very early stage. Then we also survey founder shares for current job, which is past what somebody would have gotten for their founder shares, meaning you're the founder CEO, you got a percentage for being the founder, and then you get additional equity past your founder shares because you're the CEO, which is a completely separate bucket from somebody who is a non-founder, someone who's hired in after the inception of the company. So let's look at now what this works out into effect. And Christine, I'm going to let you talk through the founder total equity, sort of the questions that you would talk to for a founder CEO of a medical device company, really any company for that matter. This is under $15 million of total financing raise. So the sample size is 81. And we showed you median 75th and max numbers, base pay, bonus, total cash. And this is where this goes to exactly what we had said, is that the base pay plus the bonus don't equal the total cash, because not everybody has a bonus, but everybody has a total cash number, right? But some people are just getting there from it being the base pay. So I'm going to say that slower. It's not the same sample sizes. We have 81 data points for base pay. I don't have the N in here for a bonus, but it's probably a small number. And then total cash is 81 people. And then we're showing you founder total equity, which could be founder shares and additional equity for the founder as the CEO, or just the founder shares. And then non-founder equity, 5%, 10%, and the maximum being 29.5. So Christine, you've got this person, they come to you. What's the discussion you have?
Well, so as we're thinking about a CEO, there's a difference between CEO and CEO founder, and the equity that they own. And so the first question, and often it's an interesting one, which is, I own equity, and I have all of my stock, right? And then when you start digging a little bit more, the mix actually becomes, maybe it's founder equity that was exercised immediately. They're all founder shares, and that's great. The clock has started. Often, if it's a CEO that has come in and is non-founder, owns equity, and then it's really actually options. It's very rare that a CEO is coming in and getting compensation as straight equity and shares. So typically what you'll see is their options. And then the question becomes, are they incentive stock options or non-qualified stock options? I'm not going to dive into that just yet because I don't want to go deep really quickly on the tax side, but we'll talk about that.
Right.
But I think the most important piece here is just really understanding, like, what am I getting? And actually, what are the levers that I can pull if I'm coming in and negotiating on the way in? My base pay, my bonus, and the equity pieces of it. Because there are certainly instances, and we see this a lot more on the like medical device, biotech side. They tend to be more established CEOs coming in and being recruited in, even if it's an under 15 million financing raise, right? Even the smaller ones. And so maybe you don't need as much cash and you want to ramp that up.
Right. And that's where the percentiles, because people ask this question, well, what's sort of the key comp factors and what's the comp philosophy? And it really depends on many factors. One, it depends on whether you have folks that are, very senior and need a mix of cash and equity. In some cases, we talked about, the question came in, I know from our early questions, about what happens with the salary and equity mix, depending on where you are in your financing. So I'm going to move to the next slide, Christine, for us to look at, because this will show some dilution, right? So the first slide was the medical device CEO under $15 million. And now we're going to look at med device, about $15 to $50 million. So you can see the median total cash is now up from 250 to 300. And the 75th percentile is up from 318 to 390. And the max numbers are up as well. But of course, what's happened here to the founder total equity is they have gotten diluted down. And the non-founder CEO has gone up from 5%, 10% to the median has gone up and the 75th percentile has gone down. So this is where we say, listen, this data is meant to give you a guideline. It is not a firm answer, but you have to be prepared for the fact, without question, that you're going to get diluted when there's more capital going into the company. And so, Christine, for that planning, now we're getting to a little more formidable stage for a company in the $15 to $50 million. What happens to this company in terms of looking at how do you plan for somebody's wealth creation and liquidity? What more sophisticated questions are coming into play now?
So the biggest one is, and I'm hoping and assuming all of you have heard about this, but if not, I'm going to just go back to basics for a minute. It's called qualified small business stock. It's certainly come into question with some of these new tax laws, but for now it actually still remains, which is, assuming you're a C Corp and you've started the clock, which doesn't mean you're vested, but if you've started the clock on your equity and you have started that when you've had less than $50 million of funds raised or assets on the balance sheet, then you qualify as a qualified small business stock and you hold that for 5 years. The first $10 million of gain is exempt from federal taxes.
Okay, you have to say that very slowly because not everybody understands. They talk about QSBS, right? And that's what this is.
So QSBS, really what you need to know is just whether you can start the clock on that and whether you have that kind of stock. And so I think what's really important is, how do you start the clock on that? Well, if you come in and you're being recruited, this is certainly not something that's available to everyone, but for the right CEO, the right executive, you can ask for the ability to early exercise. And I always say it's not an all or nothing or a now or never, but often the ability to early exercise it immediately, depending on the amount that you're getting and the amount it will cost you, you won't owe any spread on the tax because there is, or any tax on the spread, excuse me, because there is no spread. So you've now started the clock early exercising on something that still may have a 3 to 4 year vest, but when it's vested, you only then have 1 to 2 more years to complete that 5-year hold. And then what I will just say as an add-on to that is the tax benefit is by taxpayer ID and by company entity. So this applies for any investments that you're making, or if you're a venture investor, any investments in your portfolio that qualify, but it also extends to various entities. So if you have family members that you want to help support, children, sisters, brothers, et cetera, you can set up various trusts, and those trusts also get that 10 million exemption. And those trusts, we often move out of states like California to a 0 state tax. So then you get 10 million fully free and clear of any kind of tax. So I think understanding that is a really important piece. The other last one that I will just throw out, and I'm not going to dive into it, but happy to go more, is the difference between a non-qualified stock option and an incentive stock option. And the one big difference is you only owe tax on the spread of an incentive stock option when you are in AMT, because it's an AMT preference item for tax calculation. And we do this a lot with our executives, and it's not even, it doesn't even have to be done immediately. It could be done down the road too. If you fall out of AMT, you can actually exercise a certain amount of your ISOs and not owe tax on that spread. So there is a little bit of a consideration if you are out of AMT for various ordinary, it's usually when there's a lot of ordinary income, you're exercising non-quals, or there's other ordinary income driving your tax return. Then there is a break-even point in which you can sneak in some ISO exercises and not pay tax on the spread. So that's a little bit later on down the road when there is taxable gain built in. But again, all of these things have trade-offs, right? There's risks, there's costs, and there's really cool pros and opportunities, but you have to be able to understand that to really negotiate around it.
I mean, I think the point is here, what you're hearing is that the numbers are great, and we've had some questions come in, which I'll look at, but also the planning. And the earlier you plan to know what you own and how you own it, the tax ramifications, how to gift. Once you see your company's had some runway here, you're raising real capital, and you also can see that you're going to stay private for a considerable amount of time, because that's what's happening in the markets here. You actually have time to plan. I'm going to move to the next slide as well. So here's CEO medical device, because we had a question come in asking about the most widespread approach for a private company when hiring C-suite in terms of an equity component of a comp offer. So this is where the numbers have not changed dramatically in the last couple of years. It's been more the use of the numbers, right? Because you can see here that this is very stable, right? You've got now, this is the 15 to 50, the median 75th and maximum numbers, and also getting into the equity percentages, non-founder or founder. Here we go. By now, the founder equity, once you're into 50 to 90 million of total financing. The total cash, median 75th and max, things are getting very stable. And even in the non-founder equity, 5%, 6%, 7.5% max. And the founder total equity, there's still going to be a max number, because that could be somebody who really just only wanted equity and is using a very low cash number. But overall, using these percentiles is the best way to determine the comp package, where your comp philosophy is, what are the levers that you want to use and how do you want to use them, who are the key employees, and what are their priorities. I mean, Christine, I know you get this all the time, is that there are some executives who've had second time, third time CEOs, and they're very cash rich and they don't need as much money. Then you have people who are also very cash rich, but have very high overheads. They have kids in school, they've got multiple houses. So, I mean, how much of that, I mean, we see that a lot of the data really guides you, but then there's also the aspect of what can the company afford and what are the priorities of the executives.
And what are the levers that you can pull as you're negotiating coming in, and what, right, ranking those in terms of what's most important. And you're right, often if you're really out for the equity play and you don't need as much of the cash comp, then you can actually probably negotiate a pretty healthy equity package, and be able to throw, some additional kind of considerations in there.
Right. I'm going to look now real quick at some biotech numbers. I know we have a range in the audience of tech, biotech, medical device, and each sort of industry has its own unique quality here. But you can see for a biotech company that's raised 110 billion plus, which is very common, right? Biotech companies have to raise a lot of money. That the total cash for a CEO is anywhere between 575 up to 853, and it could be higher. But these we have dropped all the outliers, are not max numbers. These are numbers where multiple data points hover, and then the total founder equity is still in that solid 8 to 10%. Although those extreme max numbers, really don't exist anymore, because obviously that's not going to be palatable for an investor. And then the non-founder equity is very stable. The other piece of this that I think it's important to understand is that, we get into all kinds of refresh options, and I'm going to show those slides right now, but looking at the different equity and how you own it in option pool. But the starting point of how well you do to understand and navigate your comp philosophy and deciding where you want to be on this, right? Because a lot of founder CEOs tend to, and we had a question like, what happens with a company that hasn't even raised institutional money? The sooner you think about where you're headed for your compensation, the different levers and how you want to use them is very important, because no matter what, there has to be parity between the CEO, the number one role that you have, and the number 2 and 3 role. Let's say it could be CTO, chief medical officer, chief business officer. At some point, there's going to be the requirement to get your house in order. So if your CEO or somebody where you haven't had a lot of cash is extremely high on equity and very low on cash, at some point you're going to have to balance that, or at least acknowledge that you're out of balance and know. I recommend using J.Thelander data, of course, where you should be in the marketplace. But I know that Michelle would have spoken to this while she was on, that as they're looking at funding companies, they're keenly aware as an investor what parity is and what the market should be. And no one's trying to circumvent that. It's just more of a question of how to use the levers. I'm going to go down for a second and stop sharing and move into the option pool information. And the other thing actually to look at is the jobs that are, let's see. I want to look at one job here by region, because I know this comes up as well. Okay, so here's regional data, like a chief technology for total cash by US region. And where we show the blue and the green is where the median's the highest, and green where the 75th percentiles are highest. And this is where we've seen, Christine would love to know your approach on this as well. What's happening with geography in terms of your advice? I mean, we see that geography can matter for a certain job, but it's not consistent for every single job.
I think it really depends, and I'd be curious to see if you're seeing any data. But I think to your point, it depends on the job. It depends on the type of company. It depends on how senior that person is, and, and how far along the company is. But as you look at like remote work and this whole question around returning back to the office, I don't think a lot of healthcare companies went fully remote anyway, just in general. But I'd be curious to know, how are companies adjusting for this?
Yeah, I mean, this is where we have surveyed if you are paying remote workers differently in private companies, and we are not seeing that. And obviously for a biotech, a device company that requires people to be in the office and in the lab, that's been going on the whole time. And other roles, talent is talent. So we don't see consistent geographic differences. It really depends on the company, what the role is that's working remotely, the individual is working remotely, and how important they are to the company. So as much as I know everyone would love us to have some blanket answer to this, it really is on a case-by-case basis. But overall, we don't see a blanket adjustment. And I know there's been a lot of private companies that want everyone to come back to the office, same as public companies. But the adjustment for remote working really depends on the role. We did have a question talking about the compensation plan early on in a company that accounts for evolving risk profile of the business, and how should performance reviews be coupled to compensation to have common practices. I mean, the sooner that you can have common practices and put in place metrics that include your performance reviews, and also putting in job leveling and putting in pay structures. I mean, there's a lot of states right now that have pay transparency requirements, right? I'm going to pull this up here. So the having put in place pay plans and being able to understand where people are against that, depending on what's going on in the marketplace, is very important. So this is total cash for an engineer for artificial intelligence, machine learning in our J.Thelander engineering pay plans. And you can see the 25th median and 75th percentile. So these are an amalgamation of jobs that come into pay plans. And we recommend these starting at jobs below, at director level and below, right? So the chief and VP, the best way to look at data is by industry and by total financing. And you may do a combination of industries if it's somebody that's, finance or business development role. But obviously, we have a client today, we just ran chief medical officer data, and they're a medical device company. And we looked at medical device, and then we looked at a combination of life sciences, which is biotech, medical device diagnostics. And the best data to use is really medical device, but also expanding it gives you just a sense of who's competing for that talent. So again, at those chief and VP roles, you want to look by industry and total financing, and the director level and below, you want to open up the lens as broadly as possible and use the percentiles, 25th median and 75th percentile, to understand who's the priority and where they should be on the metric for you. And we will say, and Christine, I'd like to hear your input on this as well. When you're advising companies and you're working with, everybody from the CEO on down, I mean, do you see equity we don't see equity as being the biggest lever of compensation once you get more junior. So we're seeing that the bulk of the equity is going to the top roles.
Yeah, definitely. I mean, there's the equity plans you want to see more widespread, just from the standpoint of just retention, but
yes,
of the equity grants are certainly at the more senior level. But I guess, Jody, what would be interesting is for you to dive into, jumping off of that, how do you continue to carve out and plan for continued growth with the company and increase kind of equity grants along the way? And what's the best practice for structuring a company's equity plan from the beginning all the way through?
Well, that's the key right there, is structuring it from the beginning, right? So this, for example, you can see this is a non-founder equity for the engineer, artificial intelligence and machine learning, right, in the pay plans. And you can see equity is very small, right? These these numbers are all the way up, getting to 0.5% at the 75th percentile. So the key is to make sure that you determine the data. I'm going to hear the different types of equity grants. Is that the starting point dictates what you have to do. Because if you gave an early employee a lot of equity because you didn't have a lot of cash, despite the fact that they get diluted down, if against using market data, they're still high, but they're fully vested, at some point you can't keep giving them equity or a lot of equity, but you got to give them something to keep them incentivized. So there is no standard refresh program, and we'll look at this data because it's really on an as needed basis, but it very much depends on your starting point. How did you use equity in the beginning when you didn't have as much cash? When did you reach a balance between cash and equity? And at one point, are you shifting where equity is really a premium? Because that's exactly it right now. And Christine, you jump in here, right? Companies are having a harder time, and it's taking longer. And Michelle was telling us this, in our prep call, it's taking a longer time to raise capital. So as a result of that, you can't do all the refresh, because you typically give refresh when the equity's been diluted, but that is usually when there's more capital raised.
Yeah, I think that's exactly right. And then I think the larger, more seasoned private companies that are still private and not public yet will start mixing in the restricted stock units and the restricted stock awards, but certainly considerations there, because at vesting, there's a taxable event. So typically you see a double trigger where there's a time-based vest, and then there's an actual liquidity-based event that then triggers the tax due on it. But I do think that typically on earlier stages, you see the incentive stock options and non-qualified stock options. And, I think it is that question that we are seeing right now. And there's a mix. I think generally what we're hearing is with the reduction in valuations Employees, executives have options that are underwater.
Right.
Typically repricing of options is happening, but it really depends on how widespread and how big that plan needs to be redone and rewritten for. But that's kind of what we're hearing right now.
Now, I'm going to go through these slides so we can talk of them, I'm going to go through the vesting and the equity awards. This is just standard information, but I think we should cover it. So yes, vesting is typically, there is vesting in the equity awards. The vesting's 4-year vesting. And then there is the also type of vesting do you provide. Now, this is where performance-based vesting, time-based vesting, or a combination of time and performance-based. But we are seeing is a little bit more of the introduction of performance-based vesting as well, which is helping with some of the giving additional equity, but tying it to performance metrics, because that way it's sort of a win-win for everybody. And then 1 year of service prior to vesting, which we call the 1-year cliff, right? And then let's get into the option pool, because I know we had questions on this. So this comes from our change of control and severance survey. And this we also this comes from our year-end salary increase and option pool report and survey. So this is updated annually as well. And this shows you for an early stage company that's raised, institutional money, $5 to $15 million. The key point here, and this is where it's important to understand also, this juxtaposed against how much does everybody have to begin with? Like, did you give everybody the right amount? Do key people have too much? Do you need more equity to give because you haven't given the right amount? You went low. So here's founder shares, the employees, the employee pool, board member, meaning outside board members, not investors. And then here are the investors, right? And so you can see here that the employee pool is somewhere in that 10 to 15%. Founders, the range here is because it depends on how many founders there are. That's why there's, 20% to 53%, 54%. Okay, now the mid-stage company, there's been dilution. So now you're at the 15 to 50. Founders, total equity has gone down. The investors are going up. And the employee pool is staying pretty much the same between that 10 and 15%. And that's very important to remember, right? Because you've got to keep that employee pool in that 10 to 15%.
Jody, actually, there's a question on that. So right-sizing option pool pre and post investment rounds. For example, if you anticipate 50% dilution from investment round and want 15% of equity in the plan post-investment, should you start with 30% in the plan? Certainly avoids having to battle over getting enough in the plan later, but the pros and cons around that.
Oh, you got to say this slower, Christine. Talking about what kind of dilution do we expect?
Yes. And how do you plan if you know 50% dilution and you have an investment round and you're going to have 15% of equity in the plan post investment, should you start with 30% in the plan so that you can allow for more room?
Well, the better idea is to get the equity right to begin with, right? Because if you get the equity percentages right, then the dilution is planned for and you're moving in lockstep. So meaning if you have a CEO, let's call this a non-founder CEO, and they come in at an earlier stage of financing, the total financing is in that 5 to 15 range. They're going to get diluted. So you're sort of planning for that because they're at a higher level, knowing that that's going to happen, because it's impossible to have an anti-dilution clause. So they would start maybe at that 8 to 10%, knowing they're going to get diluted. And then you also have to plan. Here's a slide that we have that talks about what has to happen. This is, you have to have a certain percentage reserved for the future option plan. You have to have a percentage for granted annually in refresh grants, and then granted annually in new hire grants. So there are different levers to think about in terms of your option pool, what's going to have for reserve capitalization, knowing that you're going to have to use it. And this is all predicated on how well you did to begin with, because if you gave everybody low equity, then obviously you're going to really have to bump things up. If you gave high equity and people are getting diluted and they're still competitive, then you're not going to need reserve for future option plan as much. I know that's not really a definitive answer, but it really depends on what your starting point was.
And is it correct to assume that these pool sizes are for the current pool, not counting equity previously awarded or vested out of either pool?
Correct. But the point I wanted to make here, as you can see, the takeaway from this is that the employee pool is staying 10, 15, 16%. 13 now, as you're getting in, this is where it's happening. Exactly what these questions are so smart, where all these people are coming from, is that chances are you didn't get it right for everybody. It's a lot of planning, because when we do consulting projects, we look at where our client currently is for total financing, and then we look out on the horizon to plan for dilution. And that's what's great about our platform and running custom reports, is that you can run custom reports by total amount of financing raised, and then look out on the horizon and see what's going to happen for dilution. So it's very easy to plan for that. So the employee pool now, though, has gone up to, more in that 15 to 20%, because they've needed a little more. And here's what's happened in a late stage company. It's now settled back in around that 15%, though, is a safe amount, because there's no question you're going to have to adjust. And Christine, I know you do all kinds of analytics as you're looking at companies that are potentially going to go out, and you look and do all kinds of projections. I mean, there can frequently be a top off for a company pre-IPO.
Yeah, that's right. And again, it's like you kind of can run all these projections and all these scenarios, but you don't know until you get there. So again, it's making sure that you're planning all the way through and not waiting right until the end, where you're trying to
Exactly.
kind of backpedal into what you want the outcome to be.
I mean, this is where the data is so important, and to look as many ways as you can. I think that the biggest difference between a private company and a public company is public companies look between a comparator group based on market cap and other companies in their exact space. The private markets across industry is very easy to look and see what's going on and understand. So if you have people that are in the medical or the regulatory or the clinical area, it's very easy to understand what the market is for those jobs. You can look at engineers, data scientists, robotics, artificial intelligence, marketing, business development. The private markets are very stable, and they've gotten even more stable because they've needed to, because private is staying private longer. So it is not hard to figure this out, but the nuance is to make sure that you address and think about what kind of compensation plan you want, where that might shift if you're moving into having revenue, if you're moving into commercial. There's different priorities shift, and you have to be able to understand what jobs are priority at one point and when they might shift. So this question about an evergreen program to grant follow-on refresh options to employees, the reality is that it's, in most cases, there's no formal program, or there's a program, but it's not a formal program. And that covers, about 90% of the answers here, right? So that means the more you're thinking about this. So here again, evergreen refresh program, how often do you refresh options? Generally as needed, or after a financing. Do we have other questions, Christine?
Yeah, one of the questions was, just as you're going through all this, how much does this consider debt financing into the mix?
None.
Okay.
No, that's great. We just had a call with a colleague who has been doing debt financing from many iterations, including SVB, and he's going to be doing a newsletter with us, being our speaker, or putting in content exactly for this, because debt financing, while you probably know this better, Christine, they may give warrants, but it's not diluted capital.
Yep. We have a whole bunch of other questions we can kind of keep going through if you want. I think, there's obviously questions around down rounds. And certainly, we're seeing that with the mix of staying private for longer and valuations down. But what are you seeing companies do just along those lines of like staying private longer, coming up against the expiry date of ISOs and options? Do you have data on that, or is that more just theoretical, what we're seeing?
Yeah, it's more theoretical what we're seeing, only in that it really depends, again, who the key employees are. There's sort of a checklist, right? Who's the key employee? Yeah. How much did they get to begin with? And if there is a down round, there's stocks underwater, and maybe you could talk about the different pricing so that everyone understands the same language. So you're granted, there's typically a valuation. How do you understand what you when someone tells you, oh, I got 10,000 shares, why is that not answering the question?
Well, again, I think it goes back to what is the current valuation at the most recent round. That's going to be where the price of your equity is struck at.
Right.
But as your executive team's thinking about how to grant that, they should be looking at the amount of fund raised as they're benchmarking their data rather than the actual valuation. So it is a little bit of looking at two different elements of what your ownership is worth. I do think that also really differs as you're looking at all of this data across the type of subsector within quote unquote healthcare too, because that all varies. And I don't know, Jody, you did medical device and you did biotech, but the question is.
Okay, so let's look here.
Yeah, because if, again, as you're thinking about all this, for all of you sitting in the audience, right, as you're thinking about what does this mean for me? Understanding the different levers as we keep going back to, and how do you think about it as you're getting more grants along the way? What is the valuation and where is that struck at for you? And what does that mean? And then what are across all of the different sub industries? What does that mean?
Right, because some jobs, this is where it's very important to look across all industries for some roles. Like here's a CSO versus a CTO for all industries and the $15 to $50 million of total financing. And we use, and just so you know, the only equity differences are between the founder and non-founder. There's not total cash differences. So founders, CEOs, while they may have do typically have different equity from their non-founder CEOs, their total cash is very comparable. And we used to separate it out, but we stopped doing it because it got more confusing and it really wasn't impacting the numbers. So that's important to understand. And the second thing is that some roles, it's better to look across all industries because it doesn't matter the industry, because that person can move from one to the other. So it's more beneficial to open up the lens. And there are a lot of healthcare companies. We have a client right now. They're basically so they have a combination of PhDs and MDs, and they also have a very, staunch engineering department. So there's a lot of crossbreeding in terms of sector. So here's all industries, 15 to 50, median 75th and max. You can see there's quite a bit of stability, total cash. And again, that can be base and bonus or just base pay. And then here's the non-founder equity. This is the chief scientific officer versus the chief technology officer. You can see, and this is very prevalent, that the science roles tend to pay a little more because they have longer education, longer experience. So they tend to require more in terms of the total cash, but they also are not always as sophisticated in terms of the equity. So a lot of the tech companies and the tech people tend to have a higher equity. So the median's very close. The 75th and the maxes are where we see differences. Okay, now I see a lot. Yeah.
Jody, question on these charts defining total cash. Is that actually, I'm assuming bonus was actually target bonus instead of the amount paid. So total cash is what was exactly paid. Is that correct?
Total cash is what was exactly paid. So if it, so I don't give you whiplash, I'm going to go back here to, okay, here is a slide that we already showed, or let me show you so we can break this down. Okay, so here is the base pay. It's a biotech CEO that's raised $15 to $50 million. So base pay median 325, actual bonus. So this is bonus paid out, not target bonus. Total cash median being 371. So it's not a straight addition because not every CEO had an actual bonus. And that's how you get to total cash. So that's what we consider total cash, is a combination of base and actual bonus paid out or just base pay.
Perfect. You also, I don't know if you can find the chart, but I think super relevant. And there was a question that came in as we were talking about private company exits taking longer, employees leaving before the exit after years of service. What is the ability to exercise options post termination? Is it the typical 10-year expiry? Is there an extension? I know you have data on that.
I do.
Okay.
Okay, here we go. You're very smart, Christine. Okay, and we also know that this is changing a little bit. Okay, here we go. Because there is sort of the standard, which I think is more relevant. So that's a great question. Thank you for sending that in. So what is your standard post-termination exercise period for employees? So Christine, explain this to us. You leave, what does that mean? Let's say you're half vested or you're fully vested, or what happens?
You have 3 months, typically 64% of companies are staying at that 3-month standard exercise period so that you have a little bit of breathing room after you leave to exercise what's vested only. And so you typically have 90 days to do that. And that's the norm. There was a period pre-COVID back in the heyday where you were seeing a lot of private companies, mostly on the tech side, extending those indefinitely. It was a little bit crazy because then what you were seeing with a lot of private company execs was they were, and not even execs, like you were seeing this even at the engineer level, like they're starting their own venture
Crazy, right?
Because they were just jumping from company to company after they were 2 to 4 years vested. And then the long extension of the exercise period. So it's certainly, I think it also makes your cap tables crazy. So just, thinking about all of that, and it's good to see the data still kind of stays consistent around 90 days.
Yeah. Okay, we had a question on the equity. I took a glance when you were talking, Christine, and people were asking, like, does equity make a difference by industry? And it does for some jobs, right? So we looked at a chief people officer. Here is the median, because we know we potentially have some talent and chief people officers on here, right? And you can see that some of these jobs, so here's what's happened, right? This is the total cash and then the non-founder shares. A lot of these jobs across, and I'm going to say this slowly, a lot of the jobs across the same type of area. So we look at data, you can have administrative jobs, chiefs, VPs, directors, and down. And those administrative jobs are finance, business development, marketing, sales, talent, HR. Most of those jobs in terms of total cash and equity are priced very comparably, which is where I know when people are looking at data, they want to get very granular, and it's much better to be more strategic, because a chief people officer, a chief marketing officer, a chief financial officer, these jobs tend to be priced, comparably, especially if they have the same value across different jobs. Maybe chief business officer, chief finance, chief operations, right? And the next level might be HR, tends to be the next level down from that. So you can see here, it's about 0.5%. And also the cash is comparable, right? And then here's the equity by the 75th percentile, and that's staying very much the same. And then here is a VP of R&D, right? And this is across all sectors. And look how straight on that VP job is, 1% all the way across. And you'll find this. So if somebody's in a scientific role, right, a salaried scientific role could be something engineering, could be technology, those types of roles tend to have the same level of equity. Or you could have somebody who is, so we look at either, science, technical, or administrative generally. And a lot of the chief and VP roles run between 1% and 2%. Obviously, the CEO role is at the highest, and then you sort of go down to 0.5% for the next level of jobs for equity. And then you go down from there, where the staff level roles, except for the key people, really go down from there in terms of very small percentages. So I hope that helped answer the question. I'm going to look and see if we have a couple of other areas that might be worth discussing, especially yeah, go ahead.
No, well, there's a lot of questions around founder, non-founder, CEO comp, and how, I know you showed some of the data, but what do you advise companies on typically, the comparison between coming in and being a founder CEO or being a non-founder CEO, and the mix of how they should be thinking about their equity?
Well, the biggest issue for, and I'm going to show this here, the biggest issue for a founder CEO is that they get diluted down, and they get to the point where they have not been strategic enough to make sure that their comp stays competitive all the way through. And then there is too big of a gap between where they are and where they should be. And that gap is very low. It's unusual, especially for a life science executive CEO of a medical device or biotech or diagnostic. Tech CEOs tend to do a better job and be more assertive on the equity side. But the life science executives tend to be more altruistic, very focused on the science and their teams, and they tend to be more faithful, and they're thinking that they're going to be taken care of. And that is a false positive, right? Because the most important thing is that you understand the data and you figure out where you want to be on it, and you stay on that, knowing that there's going to be dilution. knowing that a founder CEO, if you don't get the right equity to begin with, you've got to hustle after that additional equity for the founder, what we talked about in our levers here, right? Talking about this founder shares for current job. So there are two buckets. So if your founder shares were not competitive to market and you were low, it's very important that you start to get to that total number, right? Which we have here, founder total equity, and that you appreciate that if you don't get to market, that when you hire other people, you're going to see that this is problematic. I mean, I just read today in one of the online publications around private companies, either Axios or Term Sheet, about two founders that are now leaving a company, right? It happens that founders get replaced. And so it's important to make sure that your equity is that your holding is competitive, because there may be changes and depending on the growth trajectory of the company. I mean, we see this.
Sorry, really quickly, with the chart up, can you compare it to, you had medical device up under 15. Someone asked if you could actually share that same thing under biotech. Under 15.
Okay, hang on.
Yeah, and while you're pulling it up, the one thing I will just add is to Jody's point around founder and then founder CEO and dilution along the way, I do think that it is really important to think about the mix between your founder equity and your CEO equity. If you are a founder and a CEO, at a certain point, you're fully vested on your founder shares, but you've been bringing the company along as CEO. And so then there becomes a mix of CEO equity, which becomes the vesting, the performance-based equity grants. And that is another great way of getting your equity up, but splitting how the board and how you think about what you're doing, because clearly you're there as CEO, you're running the company, you're important to the firm and they need you there to continue to grow. And so they should be thinking about compensating you as they would a CEO, not a founder.
Well, but it's a mix of both.
Well,
and that's exactly why
founder, they just assume you have your equity. Yeah.
And a lot of founder CEOs do not, right? They've gone low to the market. You can see the range here. This is a biotech CEO, under $15 million in total financing. And you can see the non-founder equity, meaning non-founder CEO, is running that 6.3, 75th and max, very stable. And it's going to get even more stable as you move into the more later categories of financing. But there's a large range on founder total equity. And as you go through more financing, right, here's the biotech 15 to 50. That's getting to be, more stable, the median and 75th. And look at that non-founder equity stays almost the whole time between 5 and 6%. That max number really starts to get diluted as well. I know we're running out of time. I think we're just gaining momentum. This is what happens.
I know. Well, actually, as we're on the point of founder, Jody, really quickly, at what point do you recommend a founder CEO get an executive contract with a company?
Yeah, that's a great question. I'm going to actually move to that section as soon as possible. I mean, you should do it coming in, right? But the reality is that you feel sort of uncomfortable. Most founder CEOs do. But the reality is that you're going to hire another executive, and at some point, that executive is going to want that agreement, right? And so that becomes talking about your severance, for example. Hang on. Let me go to share my screen. Oh, here we go. Share screen. Here's severance, right? So to which executive? So you put in an employment agreement that covers things like change of control and severance, accelerated vesting. I know we're running out of time, so I don't want to start talking too fast, but those are just things to think about, right? To have severance, the CEO, other chiefs, and in our surveys, we show the different, how long severance is. So 7 to 12 months on average. And then there are some that are 4 to 6 months, some that are looking at 13 to 18 months. And then I wanted to talk about the last area is the, single trigger, double trigger, just to talk about, does the CEO have accelerated vesting? And obviously the CEO sets the foundation for this, because the CEO does, then it's easy to put it in place for the CFO and the other chief roles. So having accelerated vesting equity in the event of a change of control, right? And is the CEO, it's typically 100% acceleration. So these are topics that are important to put into an employment agreement. And I am going to put a pitch in. We work very closely with Wilson Sonsini, and they do a great job. And also is the CEO acceleration. I know people are surprised it's a combination of single double trigger, but again, these are to be adjusted based on your negotiation skills. But a single trigger for the full acceleration is that the change of control alone is enough to trigger it, and a double trigger also means that it has to be a change of control and there has to be a termination. I'm going to stop sharing. We've covered a lot of information, and I don't know, Christine W. Yes, if you want to come back on to wind us up, we've had a lot of great questions. We're going to send out the link to participate in the survey where you can have access to this. Schedule a time to speak with us. Christine Leon Connors, obviously you and your team have amazing expertise, and Christine W. and Herminio on your team. Your whole team was so great to put this together into our audience. Impressive. Boy, what great questions.
Well, thank you. Thanks for your time. Thanks for Jody and Christine Leon. As Judy mentioned, we'll send out the link, and so that if you are interested in participating in the survey, and Jody will share some of the data. And
we'll also send out the recording. So if you feel like you wanted to dwell on something a little longer, I know we move fast. And lastly, we'll just remind everybody that if you took pictures, we're certainly glad for you to reference those, but please do not post those online or, put those up for anybody else to see. Great. Thank you.
Thank you.
Thank you.
All right, everybody, take care. Thank